All right, looks like we're at time. Let's go ahead and get started. My name is Chinda Chun, and I'm with NACB and the Consultants Training Institute. Before we get started with today's Around the Valuation World International webcast, I wanted to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have an AVW subscription to the international version of Around the Valuation World, you'll receive a CPE certificate within 7 to 10 business days after today's webcast. If you have any questions during the webcast today, please use the Q&A feature in Zoom, as those will be directed to the panelists. And if you have any questions about NACB or any technical questions, you can reach me by contacting me through the chat feature as well. With AVW and the AVW International Webcast, we try to cover all the current trends and hot topics in the industry. However, with the 1 hour time frame during this webcast, we're not able to cover all the topics. So there is a link to some additional resources that will allow you to stay updated in the industry as well. So those links are in your material. And with that, I'm going to turn the time over to our editor. Say we have Wolfgang Nies, Andrew Newman, and I believe Pratik will be joining us shortly. And today we'll be going over some news items, GAC news items, discussing conference. And also we have Carla Nunes and James Harrington today going over the global economic update. And I'm just going to jump right into this. With the conference coming up next month, it's going to be in Las Vegas. You're still able to join us virtually, or if you want to join us live, you're able to do that as well. We do have 2 special Around the Valuation World morning show webcasts, and you will receive links to that a few days prior to December 12th. The link will be available to you, and that's some extra CPE that's available to you that we offer through our conference as well. So look for those emails, and hope you can join us during those the 2 mornings for the morning shows. And then let me just play this real quick, and then we'll get started with the webcast.
Right before our eyes, nearly every aspect of our lives is rapidly evolving. So much so that it is difficult to keep up. This rapid evolution presents opportunities for us to examine where we have come from, assess where we want to go, and redefine ourselves as professionals to set new levels of achievement, while also keeping up with the world as change unfolds.
This year's conference will feature established experts and emerging trailblazers from within the industry who will address key areas where there are emerging opportunities to redefine who you are in the profession and in your practice, leverage your business valuation and financial litigation expertise to enhance your value as a full-service business consultant to your clients, embrace the strengths and benefits of intergenerational collaboration in your workplace, expand your knowledge and exposure to emerging areas of practice and standards in the global marketplace, and master technology to increase your productivity and your bottom line.
During this conference, solutions will be presented. Discourse will be encouraged. Like never before, the future presents a wide array of opportunities for us to reinvigorate our lives and redefine our careers and the profession.
All right, and with that, I'm going to turn the time over to Wolfgang, who will get us started today.
Yeah, thank you, Chanda, and thanks to Carla and Jim, and to all the participants. It's a great attendance today. Yeah, it's a pleasure for me to introduce Carla Nunes and Jim Harrington. Carla is Managing Director in the Office of Professional Praxis Kroll. She's providing firm-wide technical guidance on a variety of valuation, financial, and tax reporting issues. She's global leader of Kroll's Valuation Digital Solution Group, which produces the well-known cost of capital navigator, for example. She is practitioner director in the board of FMA International, Kroll's Institute fellow. She's co-author of many multiple publications in the area of cost of capital and goodwill impairment. Also, great welcome to James. He is director at Kroll and one of the leading contributors to Kroll's data distribution platform, Cost of Capital Navigator, and he's also co-author of the Valuation Handbook. It's a great pleasure for us to have you here today. And we are, from the perspective of EACVA in Europe, we are very much looking forward having Carla with us next week in Germany during our conference in Düsseldorf, and she will speak on the ESG topic. But today, back to global economics and updates following the US election. Having said this, I hand over to Carla and Jim. Thank you.
Thanks so much, Wolfgang, and everyone else for inviting us. We're going to do an update, but disclaimer, these are the views of Jim and I, not necessarily those of Kroll. The interesting thing here is that we're doing a little bit of a global outlook with a focus on not just US is a major economy, but also what's happening with the Eurozone and Canada, for example. We will have a longer session at the conference in Las Vegas, where we will have more data on the US and US markets, etc. So a little different twist, so you can attend both and you'll get different content. And looking forward to going to Germany next week and talking about ESG topics. So here we're going to go through current economic conditions, have just a little bit of an update on long-term projected economic growth, not short-term, because economists are still figuring out what that's going to look like post-US elections. And then we'll see what's going on with risk-free rates in major markets. Jim is, doing a highlight of some of his analysis on presidential election years versus non-presidential years and what happens to US markets. And he'll have an even more extended version of that in the Las Vegas session. And then we will finalize to just a little touch base on how the Eurozone equity risk premium is looking like post-US elections. So let's get started. All right, so let's talk about current economic conditions. And I like to start, and Jim and I look at this like on a regular basis to see what has happened since COVID to both the monetary and fiscal policy and how that's impacting markets and businesses and the outlook for valuations. So this chart here shows the combined major central banks' balance sheets. So that would be the Federal Reserve in the US, or Fed, European Central Bank, ECB, for the Euro area, and then the Bank of Japan and Bank of England. And of course, by far, both the US and ECB are the largest holders of assets. But what we can see here is that when COVID began, all of them increased significantly, like they more than double at one point at the peak in February of 2022, the assets that they would buy from the financial system. So it started with government bonds and securities, and then it got extended to even equities in Japan. Japan owns 50% of equity market, for example, as well as corporate bonds. And so that had a big impact on interest rates and also pervasive around the economy. Now, we're seeing now quantitative tightening in some of these places, meaning that the size of the balance sheets are decreasing, but they're still much higher than they were back in, pre-COVID. And so with that, let's look at the fiscal policy. And the reason why we'll start with the US, obviously the US economy is the biggest in the world, and has their actions have a repercussion around the globe. And one of the things that have been impacting interest rates, for example, and how the economic growth has looked like, has been the US fiscal policy response to COVID-19. So we actually had this chart like, last year we had it, and it looked actually quite different. So there was a revision of what the size of the economy, the nominal, as measured by nominal GDP or gross domestic product, and the size of the economy, it seemed like it had declined from 2019 to 2020 way more, like almost 3% than would actually happen after revisions to economic data. So, the statistics bureaus of the various countries, they get more recent and more reliable data, and so they update their estimates. And so what happened is that the US economy during COVID only dropped by 0.9%. So that's compared to 2019. The combined COVID-19 fiscal packages was 26% of 2019 nominal GDP. That's the biggest weight of any country in the world. So we're not talking about just the absolute number, we're talking about percentage. We're talking about levels that we've seen in World War II. And yet, we dropped by a lot less than what was needed in terms of what was injected into the economy. And you may say, well, I think GDP would be lower if you didn't have that assistance. Well, that's fair, except that more than half of this 5.7 trillion were approved after 2020 or at the very end of 2020. So they only came later. And they came later through a lot of different fashion, but 2 trillion alone was to checks. The government wrote checks and they sent them to people's homes. So it was really a transfer of government funds into consumers' hands, and that has some repercussions in the economy. Did they stop there? No. So after that happened, here's some estimates of plans that the government in the U.S. Under the Biden administration passed to revive the economy. So they thought there was infrastructure and semiconductor investments, Inflation Reduction Act, which had nothing to do with inflation. It was, again, like green investments, etc., and student relief loans. And this is about another $3 trillion, but over a 10-year period, as opposed to that earlier slide, which was, in the space of a year and a year, really. It's not even a year and a half. And so can we stop here? Well, no. I mean, we know now that Trump has won, obviously, but this was estimates of what their plans announced in the campaign trail would cost. Just this was updated October 28, just before the election, and it's important to see because it's still the base case. Now, this is an independent estimate. This is the Committee for Responsible Federal Budget. And their base case is to say, hey, if you enact the 2017 tax provisions and you renew them or make them permanent, that's going to cost another $4 trillion. And then there's other plans that were announced during the campaign trail, which may or may not happen. To offset some of those things, the Trump administration thinks that through tariffs they could offset some of that revenue loss of extending the tax cuts and economic growth. Now, a lot of economic theories have said, oh, we can spend through government and increase growth. But over time, what really the history shows us is that it does have an impact for 2 or 3 years where you have higher growth, but then it goes back to trend. And so if that's the case, we're in trouble in terms of how much debt it's going to be taken on by the United States. And the reason that matters is because it's interest rates. We care about where interest rates long-term are going to go. So this chart shows how much U.S. Federal debt, so the national debt is held by the public. So like it's actually publicly traded. And at the end of the second quarter of 2024 was already above 100%. And we can see that the increase, and that's like the green line, has really picked up, has been picking up over time, but really picked up. The green line is the US GDP, but then we're now we're now at a point where the federal debt held by the public is about the same size of the GDP, and that has consequences. So this is the expectation from the CBO, so the Congressional Budget Office, which is an independent office that rates like the current tax legislation. This was the current tax legislation as of May 2024, before any plans that candidates had announced during the campaign trail in the US. And they said in their report back in May that we're in the United States, we're in a unsustainable trajectory in terms of debt. And so this is not consistent with a AAA rated country. And some economists say the moment you get to, say, 150% of GDP, you're going to be in trouble. Your interest rates will skyrocket. The US has a special position in the world. They're like the reserve currency of the world. The risk-free rate in the US is used for trillions of dollars pricing of securities around the globe. And so they have been benefiting from that status of the reserve currency by having, the proxy for the global risk-free rate, and investors have been willing to continue to buy US debt. But if there is some, hesitation about the risk of that, that holding that investment, we can see long-term interest rates go up potentially. And that we've seen that since actually since this year, where investors have been worried about where the US debt is going to go and what that means for long-term interest rates. But as I said earlier, it does help growth in the short term. So the United States have grown at a much faster pace. This is quarterly real GDP growth annualized. They have grown at a much, much higher level than economists had predicted. In 2022, all economists, the great majority, were saying we're going to run into a recession in the United States. We're going to start a recession in 2023. And that didn't happen. And then they said we're going to have a recession in 2024. And that didn't happen. And in fact, if you think that the long-term growth rate is around 2% for the US has been growing at above potential for a number of quarters. Now, part of that, of course, is the money that got injected into the system. So this is what, excess savings for the United States consumer looked like versus what they would have been if there was no COVID aid. So at one point, at the top of the excess savings, consumers had $2 trillion extra savings. Remember the checks I said that the government wrote? Guess where they were? They had the excess savings. And so as a result, the consumers had a lot of power. They could buy a lot of stuff. And in the US, consumers account for 70% of the GDP. And so that means that they were able to increase or contributed to the increased quarterly growth that we saw in the prior chart. In fact, Jim likes to say something about this chart. Right, Jim? What do you usually say?
I usually like to title this particular chart the "Party's Over" chart. The money that was injected into the system, you can see the peak there was just ginormous, is now gone. As of May 2024, all that is gone. You could say, short expression, the party's over. But if you ever wondered why the US economy didn't go into a recession, this is a big part of it right here. But that money's now gone. Back to you, Carla.
Thank you. Yeah. And so US consumers are now starting to use credit cards to buy. And so what that means is that if things continue this way and you're incurring more credit card debt, we could see a slowdown in growth coming next year. Now, this is a chart that shows, are consumers happy? Given that they have all that extra savings, right? Are they happy? Well, when inflation picked up, it was starting to pick up in 2021, and all of the central banks in major countries were saying that inflation was a temporary or transitory phenomenon because of the COVID reopening. But then the supply chains continued to be a problem. People were still labor supply shortages were still another problem because people were staying at home and using the the checks and whatever the aid that governments gave. And so when Ukraine was invaded by Russia, we had another shock to the system and to supply chains globally. And so that really caused inflation to spike up. So in June of 2022, the US consumer was at its lowest, the record low level of consumer confidence since this data started being collected in the late 70s. They has been increasing a little bit, but it's not back to prior to COVID or even 2021, when suddenly all that money was coming in, and you can see that it was like a little blip above the long-term average. So the consumer has been spending, but they're not completely happy. What has happened in the euro area? Well, in the euro area, remember the Russia's invasion of Ukraine, that had a really negative impact in the euro area. And of course, particularly in Germany being considered the engine of growth in the euro area, that has been really dragging growth overall for the Eurozone. And we even have barely, like flat. It was not considered a recession, but at the end of the second quarter of 2022 and beginning of 2021, 2022 to 2023, we see like a slight back-to-back negative quarters, but it wasn't considered exactly a recession. Although in Germany, it was considered a recession. There was a pickup in growth in Q3 of this year. That you see that 1.5%. But suddenly, the elections in the US are causing a lot of European investors to worry, because if there are massive tariffs in the tune of what has been announced in the campaign trail was 10 to 20% across the board. For China, it would be up to 60%. And so for economies like Germany, which are very export driven, that could have a material impact for their exports to the United States. So this recovery in Q3 may suddenly retrench again. The Eurozone consumer confidence it has been going up for sure. They also had a record low back in September of 2022. Again, remember all the spikes in inflation from the oil reliance on Russia, and the spike in energy prices, all of that, and the inflation really going to 40-year record highs. It was really shaking up the consumer confidence, and now it has been recovering, but we only have data through October. So we'll see how this unveils after we start getting more clarity on what these tariffs plans are in the United States and how that could impact the EU consumer. Certainly, we're not back to that state steady state, which is 100 is there. We're not back to that level, which we were in 2021. Just after COVID, we were back to like being optimistic as a Eurozone consumer, and now we're not there. Canada has been struggling for a while. Canada here, they don't have data through Q3 of 2024, so it's only through the second quarter of this year. I think it was supposed to come out this week, but anyway, we needed to have the data here for you guys to see. And so they've been, really struggling with growth. Arguably even worse because it's been for a prolonged period than the Eurozone in some ways. And with elections coming up, and this anti-incumbent, sentiment across the globe. So, this year was the year of elections. Over 100 countries had elections, and then Canada will have some elections next year, as well as Germany had, of course, the surprise elections, because the government fell. That that could cause some instability into the future. But in the case of Canada, this explains also why they started cutting interest rates faster than the United States, because in the past, Canada and the US were very much aligned in terms of monetary policy. But in this case, they need that stimulus to be going through the Canadian economy. Now, one other thing that has helped the United States in terms of staying on track in terms of growth and having consumers continuing to spend is that a lot of them had jobs. Okay. And so this chart shows you what the number of jobs on the left-hand side, the number of jobs created each month, what was expected by market analysts, what was the preliminary estimate, that's in green. The other one, the expectations by market analysts is in blue. And then that salmon orangey color is what the revised numbers were when the actual data comes out firmed up. And we don't have that yet for October. But what we can see is that in August and September, we were still creating jobs at a certain rate, although if you think about $100,000, I'm sorry, 100,000 jobs is actually a healthy job creation. 200,000 for the US is really expansionary. So to give you some benchmarks, October 2024, you really can't rely on that number because there were two hurricanes that came through in October, as well as and so those people were not counted as having a job, because of the storms and the relocation. And there was a big strike by Boeing, the aircraft maker. And so these numbers are not really telling us much. So we'll see what happens in November. But the reality is that on the right-hand side, you can see that the unemployment rate, which was starting to tick up, has now stabilized at 4.1%. It will probably oscillate, and maybe it will go up again, but it has stabilized at a level that it's still pretty low historically speaking. So this chart shows you what the long-term view on unemployment is, and during recessions. The recessions are the shaded gray bars, and 4.1 is still not a recession at all. I mean, when you see recession periods, you don't see unemployment rate that low. So the US is still doing pretty well. And they're actually doing, they're doing better than expected. They've been the engine of growth for the world economy in 2024 and even 2023. So the question is, what's going to happen for 2025 after a new administration comes in? In Germany, and this is there are two measures of unemployment for Germany. One is an internal, the Stati, like the statistical agency in Germany, that puts that version, like it's a different definition of unemployment. Whereas this version we're seeing here is to be consistent with the EU measure. So you have more like an apples to apples comparison. And so if you think about the apples to apples comparisons, the September 24 unemployment rate is 3.5%. Which is ticking up, but it's still pretty low and below below average, long-term average. The internal measure is higher. When you look at the Germany's statistical agency version of unemployment is higher, but it's still relatively low compared to what it was, historically, even like just after the global financial crisis. So remains to be seen what happens here and what's the impact of next year's elections. In the euro area, or I'm sorry, the euro area, the unemployment rate is 6.3% in September. That's still pretty good. It's actually pretty low, and that means, obviously there's more frictions in the European Union than in the US. People don't lay off workers at the same way. They don't fire workers the same way due to economic upheaval. But there's still some, shortage of workers in some areas in the euro area. Now, the implications here is inflation. So inflation, has, as I said, 30 to 40-year record highs during like June through October of 2022, depending on which country. And most central banks have now been able to get inflation back to target of 2%. However, there's been an uptick in October. So the inflation had gone to below 2%, say in the UK. It had gone to below 2% in Canada, in Germany, Eurozone, and now it went back up. And it wasn't energy that caused this. It was actually food prices. In addition, services inflation continues to be stubbornly high. So this shows you the picture of what is the headline inflation and what is services inflation. And if you look at the green bars, you can see that in all of these countries, they are far from the 2% target for the central banks, to think that they won the inflation battle. So the inflation battle is not won yet. They have been, starting to cut interest rates. We'll talk about that in a second. The central banks have been starting to cut interest rates, but they're still worried that there's this stickiness. This services inflation is still high, and part of that is that labor shortage that we're talking about earlier, that we're still seeing there's not enough workers for the services sector. Now, from a long-term perspective, markets do think, and economists think, that the inflation battle has been won. And so in this case, for example, we look at various sources because since COVID, we were already looking at various sources, but since COVID, like the expectations by economists were so different. And so what you do from a statistical standpoint is you don't know who the source is, which model is more correct, but they're all reliable in the sense that they're reliable sources. So what you do is you look at a number of sources and you take the median. And in this case, the long-term expectations for the US are at 2.3% for inflation, which is a little bit above the 2% target, but close enough. But at one point, this was more like this was much higher. Inflation expectations were going up even over the long run. So there was some concern whether the Fed would be able to control inflation or not, which they now seem to have accomplished. And this is a similar chart for Germany, except that we have fewer sources that we can use. But the median right now for long-term inflation, so over the next 10 years, is 2%. But just to compare how economists were worried, back in November of 2022, remember when the height of the 40-year high of inflation, the expectations for Germany were 2.9%. This is a very significant change. If you think about the long-term, value of your business when you're doing valuations and you're looking at terminal value, it makes a big difference whether long-term inflation is 2% or almost 3%. So with that, I'm going to talk about that other component, the long-term growth rate, the terminal year value. So this is United States. Again, looking at various sources, they're now saying that the long-term real GDP growth is going to be, the median is around 2%. Believe it or not, this has actually been tricking up a little. It was at 1.7, then went to 1.8, then 1.9, and now it's at 2. And that's not typical because it had been the other way around. GDP growth in real terms for the US had been over the years trickling down. And so I think that what economists, and Jim and I have discussed this, one of the possible explanations that economists are thinking that the, the, the trend growth might be higher is because of AI, artificial intelligence. That if productivity goes up significantly, that things are more efficient, that you can have like a higher long-term real growth. If you put that together, the long-term inflation and the long-term real GDP growth, you get to the overall projected long-term growth rate for the economy. In this case, with these expectations, we have 4.3%. And that's important because when you're doing evaluation of an existing firm, you typically don't see or shouldn't have growth rates in the terminal year significantly higher, or they probably shouldn't be higher. This should be a ceiling for your terminal year. Now, there are exceptions. For example, you have a high growth industry like in tech, where it takes longer to get to that terminal value, then you could have a higher rate if you just have 3 to 5 year discrete forecasts. But just something for you to consider. And then if you look at Germany, the expectations of the next 10 years are being driven significantly by the low expectations for 2025. And so the long-term average, and then 2024 is still being counted. So the long-term average for Germany, if you look at the last forecast year of each of these sources, then you're looking more like at 1.2%. But if you take into account the low growth in the next couple of years, we're talking about 0.9%. So just something to take into account, that this low growth scenario, or even in and out of recession in Germany, is having an impact even in the long-term growth rate. So depending on what you use for your assumption, on the left-hand side in green, you could see what the long-term average for the economy would be, according to these economists, 2.9% or 3.2. So lower than the United States, which makes sense. We expect growth in the United States in nominal terms to be higher than in Germany. Now let's take a look at what risk-free rates have been doing, and then we'll go to Jim to go to the stock market analysis. So we can see, of course, this is 10-year yields for UK, US, Canada, Germany, and Japan. And we want to show this to see the behavior since the global financial crisis. And as we can see, most countries have now seen their 10-year yields match the immediate after the global financial crisis. So it's at much higher levels. Both the UK and US have been, seen a lot of volatility, but in particular, this worry that there's going to be more government spending, or even if it's through whatever the form it takes, more government spending will be financed by debt, and that puts a upward pressure on long-term yields. And the UK, as we know, they also have a new government, and they came up with the October budget, and again, it was promising of more spending, and so that has caused yields to go up more recently. In Germany, there's been a lot of discussions that, for those of you who are based in Germany, you'll know this even better than we do, but the constitution requirement to not have budget deficits above a certain level has restrained how much the government can issue in terms of debt. But now there's expectations that if the government changes, that we could see a relaxation of that requirement, and that has been leading to a lot of volatility in German bond yields as well. Now, in the past, we were doing a lot of, talk about normalization of risk-free rates. And what we meant by that, we didn't force people, obviously, to say, oh, let me use normalized risk-free rate. What we were saying is that because these risk-free rates are being abnormally impacted by the actions of central banks, then you want to make sure that if you are estimating your equity risk premium, that it's consistent with the levels you are estimating for the risk-free rate. And so we were doing a normalized risk-free rate, which at first it was like doing long-term averages. And then we started relying on a build-up method, which is based on the Fisher equation by an academic from the 1930s that essentially says that your nominal risk-free rate is a combination of your expected real rate and the expected inflation. Why does this matter today? Well, that real rate, which we call, academics will call it, the neutral rate of interest, the equilibrium rate of interest, or the natural rate of interest, has taken a lot of attention, even in financial markets. Nobody used to listen to these terms, this neutral or natural or equilibrium rate of interest, and now it's like in the Wall Street Journal. So what's the issue? Like, this was an article from last year. And they were saying that estimates of the neutral rates could take on greater importance in coming months. So if the neutral rate has gone up, this could call for higher short-term interest rates, so the central banks cannot cut as fast, or it could keep long-term bond yields higher for longer. And then this is another article that just came out from The Economist, and they explain what this real rate is. And they say, well, you can't really observe it directly. You have to estimate it. And academics estimate what that rate is. And they say, well, for example, the Fed, until recently, they were projecting that neutral rate of around 0.5%. But now a lot of the voting members at the Fed say they think that it's possibly much higher than that. And so they also call this R star. So if you search for these terms, R star, you'll show up in the Financial Times and Wall Street Journal, The Economist. Lots of newspapers are talking about this. And so what that means is that could it have an impact if the real rates are higher of where you end up on your normal levels of interest rates when the Fed stops cutting? So the Fed has cut rates since September of 2024 by 75 basis points. There is now 50-50 chance that they will still cut in December, but there's a lot of talk with Trump being in power that the Fed will start cutting interest rates on a slower pace. And part of that is because economists think that tariffs will have an inflationary impact. And if inflation is higher, the Fed cannot cut rates as fast. Let's contrast this. So like the Fed target rate, the policy rate is somewhere between 4.5 and 4.75. In the Eurozone, the ECB, they have three rates. This is the deposit rate, important rate to manage monetary policy, and they started cutting rates earlier than the Fed. And part of that is because you saw the growth has been sluggish and inflation was going down faster. So the concern about growth became more important if inflation is controlled. And so the ECB started cutting rates in June of 2024. But there's also 75 basis points cumulative. If growth continues to slow down and inflation is under control, we could see continued rate cuts in the ECB. But big question now with Trump in power. And then finally, Canada. Canada is the one that has cut rates more quickly. And remember when I said that they're in worse place than the Eurozone in terms of the growth, quarterly growth. Well, they started already cutting also since June, but 125 basis points cumulative. And so this is where markets, as of Thursday night, expected rates to end up less than a year from now, by September of 25, where they think that rates, this also includes the Bank of England in that orangey punch color. But we're seeing that there's a big difference between the ECB that is expected to be at 1.9% by markets versus 3% for Canada and 4% for the Fed. And then the reason why I talk about the real rates is because we, unlike the journalists, have been looking at this since 2015. So we have many like real rate estimates by academics that we've been tracking since 2015. And what we've observed is that indeed estimates have gone up for the real rate in the United States. And so if you combine that, real rate plus long-term inflation expectations, you get to a concluded fundamental rate for the United States at around 3.5%. And we know that rates are now higher than this. But this is something to think about when where the Fed is headed. In Germany, we have not as many estimates of the real rate, but we have a number of them. And so our estimate for that normalized risk-free rate would be 2.5%, which is really like around where, for example, the 15-year yield for German bonds has been over the last several months. And so, again, in both cases, we're saying don't use a normalized risk-free rate, use the higher of the spot in the normalized risk-free rate, because we're finally getting into a environment where you don't need to normalize risk-free rates. And the Canada is around 3.5%, like the US. With that, I'm going to turn it over to Jim to go over some financial market performance.
Thanks, Carla. Isn't she wonderful? That was great, Carla. I just want to give a short preview of what I'm going to talk about in Las Vegas. And let's talk about the S&P price index in the US. This is since before COVID. You can see over there on the left, the big dip down 33.9% in about a month during COVID, bottomed out on March 23rd, 2020, recovered some. Then we had the downward dip in 22. You can see that this year we're up about 23.6%. Also, I gave you the recovery times here. COVID, we recovered over on the left-hand side in half a year. In August, I think it was August 18th, we recovered from the COVID low very quickly. Not many people saw that coming. Overall, since the COVID low, the market has increased in the US as measured by the S&P price index by 163.4%, which implies about a 23.1% annual rate, which is just sort of incredible. Now, we always like to talk about just a few stocks have driven the market. Carla mentioned AI and all this other stuff, but generally the high-tech stocks have driven the market. And you can see this is what you would have made if you would have invested in the S&P 500 price index or total return index this time, in the FANG and the Mag 7 10 years ago. And you can see that the returns for the FANG and the Mag 7 far outstrip the returns on the market in general. Oops. And this is the Stocks Europe 600 price index, the equivalent of the first graph I showed you for the S&P 500. The big takeaways from this, it's a very similar pattern to what we saw, the big dip over there on the left, down to the March 18th, 2020 COVID low, and then a recovery, and then a dip in 2022, and then slow but steady recovery. The big difference here, there's two big differences between what we see in the US and this Stocks Europe 600. One is the recovery times. The recovery times from these big dips took much longer, significantly longer. For instance, over there on the left, took a half year to recover in the US from the COVID lows, took about 1.13 years to recover in Europe. Another is just outright returns. The overall increase since March 18th, the COVID low in Europe as measured by this index, to today, till November 18th, is 79.8%, far below, about half, less than half of what in the United States. But look over on the right, the 2023. We're up about 23% in 2024 so far in the US. This Stocks Europe 600 is only up 5%, lagging significantly behind. And if you look way over there on the right, you start to see a little dip down there. And Carla, what does she talk about? Europe is sort of on nervously awaiting to see what's going to happen with the new administration. President Trump has talked a lot about
Tariffs?
Tariffs, talked a lot about tariffs aimed at various countries, China, Mexico, and the Eurozone. Okay, and you can see that's reflected recently since the election. We've had a little dip down there in Europe in the stock market, and that's probably caused in part, if not largely in part, by the fear of what the new economic outlook coming out of the United States will be, and their attitude and our attitudes here with tariffs toward, the Eurozone, China, Mexico, etc. Now here I like to do a little thing. We're going to have an expanded discussion of this in Vegas. Just S&P 500 index performance by president. This is going all the way back to John F. Kennedy in the early 60s till today. And you can see that in general, the market has increased pretty rapid clip. $1 invested the day before Kennedy was inaugurated would have grown to $98.60 by November 8th, 2024. So in general, it's been a pretty good run since the early 60s. Here is each president's return, annualized compound returns during their presidencies. And you can see there were 2 presidents only that had negative returns during their presidency, Nixon and Bush Jr. The rest of them had pretty good returns. And I like to talk about why did Nixon and Bush Jr. have negative returns. You can see on this, the red, sort of the pinkish bars are recessions. Nixon and Bush Jr. were the only 2 presidents to have 2 recessions during their presidencies. And we remember Bush Jr. had one. That was the dot-com crash, the remnants of the dot-com crash, which caused a recession early in his presidency. And then the big one, the global financial crisis in 2008, 2009, that was a bigger recession. But those are the only 2 presidents that had 2 recessions during their presidencies, and the only 2 presidents that had negative returns during their presidencies. Here, I just like to list out all of the presidencies, their compound annual returns during their presidencies, whether they overperformed or underperformed the market in general. Overall, the market performed about 7.4% over the period. Up top there, you can pick out whatever president that you like the best. Did they do really well? I got to get rid of the poll number there. But did your favorite president do well, or did your favorite president underperform the market? And it's just sort of a neat thing to look at. This one is election years versus non-election years. Election years, 6.1%, non-election years, 7.7%. In other words, non-election years, the market tends to do better. Why? Probably largely in part due to the uncertainty injected into the market during election years. Now, this year, the 2024 election year, is highly unusual. This are price returns through the election, November 5th, 21.2%. Highly unusual to the usual election returns of 6.1%. Carla mentioned AI, she mentioned other things, maybe expectations of a change in policy. We don't really know. Quite honestly, we'll have to wait for more information to come in. But this year's returns in the US stock market for an election year have been highly irregular on the upside. Here, we like to talk about divided versus united government. There was a famous pundit that said, that when the US government is divided, and they can't do anything, that's when everybody does better. The market does better everything. And that actually sort of bears out in this analysis. United government is where either the Republicans or the Democrats hold the presidency, the House, and the Senate. That's there in the middle, sort of middling, sort of typical returns, 8.7, 7.4. Up there at the top, you can see the first three lines, divided government, where one party controls one branch or two branches and the other party controls the other. You get better results. Now down there at the bottom, those bottom two rows sort of have not much population there as far as the number of days that those conditions actually existed. They're way negative. That one Republican president with a Democratic House and a Democratic Senate has the worst performance over that period. Why that is, I'll leave the politics out of this, but that it is an interesting statistic. Here is inflation-adjusted stock market returns. Just like everything else, going to buy groceries, buying gas, whatever, inflation takes a bite out of just about everything, including market returns, as we all know. Okay, so here I've got the most recent 1, 2, 3, 4, 5 presidents with their nominal returns and then their inflation-adjusted returns. And you can see that inflation took a bite out of every president's market returns. It was more significant. The bite was pretty significant under Biden. And why? Because we had those 40-year highs in inflation from 2021 till just recently. Okay, so it's just interesting to look at. It's like I say, if the market goes up 10% and inflation is 7%, you only really made around 3%, and that's reflected in this graph. And now Carla's going to finish up with the Eurozone equity risk premium, which is actually pretty interesting. Go on.
And this is just a 2-minute update for post-election. Just so you know, we do look at a number of economic and financial market indicators and see how they have changed over time to see where we are in risk factors. So we have a trend line of what equity risk premium would be, and then compared to, in this case, year end of 2023, how have things moved? And in general, they're sort of the same, except that volatility has gone up, but credit spreads are still very, very low in the euro area. So let's see then just on the quantitative models, which is what we can see what happened since the election, is we look at 3 different models, but the one where we put the most weight is the bottom one, which is the dividend discount model top down. And what that means is that we look at market investor earnings estimates for the index, and then we make a DCF, like we put together a DCF and solve for the current market index to get to that IRR, or internal rate of return. And then by subtracting the risk-free rate, we can get to the implied equity risk premium. The reason why we have several models is because these DDM, discounted dividend discount models, are very sensitive to the assumptions you make. And it's not clear which assumption is definitely the best. And so rather than just using one, we actually look at a variety of models where for the payout ratio, for the payout ratio in the terminal year, and what we use for the projected year 1 earnings per share. And then one of the things we need is the long-term growth rate for that terminal year. Remember, the economy and overall markets tend to grow at the same rate, so we use Germany as the base because our Eurozone equity risk premium is from a German investor perspective, because we use that as the proxy for the risk-free rate. So using these estimates, you can see how the various model specifications, there's a lot of noise, right? But they do seem to trend the same direction. And that's good because it tells us that we can see the relative risk going up. And then by taking at the median of those estimates, this is what we can see, that after the election, that little uptick to 6%. Now, we don't change our recommended ERP immediately after like there's these variations. But so far during the last year or so, we were saying that our recommended ERP for the Eurozone was between 5.5 to 6, but on the lower end side of things. And this just shows that investors are a little concerned about what might happen with tariffs when we see that uptick. So in summary, this is our our recommendations over time. The risk-free rate that we've been using versus the recommended ERP, the range. We're still at the low end of the range of that 5.5 to 6 for the Eurozone, but knowing that things can change in 2025 depending on the impact of U.S. policies to Europe. So with that, I think we thank so much everyone who joined us. I don't know, Wolfgang, if you want to say a few words.
Yeah, thank you, Carla. Thank you, Jim, for this brilliant overview and deep dive in some topics. And as Carla said, for the US, there will be much more during the NSCVA conference. And for the European attendees, next week we will have Carla with the ESG topic with our conference. Again, thank you. Thanks so much to you both. Thank you for your participation. And one last comment. We will close our buffet on topics for this year in December. And as a dessert in the Around the Valuation World International webcast, we will have Michael Gregory. He's a famous mediation and negotiation conflict resolution specialist, and he will talk on a soft skill topic, how to handle uncomfortable situations, and it will be on December 9th. So to be very, very prepared for the Christmas time. Maybe it's a good start for the Christmas season. So thank you for your attendance. Thanks to Carla, thanks Jim, and Chanda for the technical support. Thank you, and see you in December.
Thank
My
you so
pleasure.
much.
Thank you.